Sarah, his message all year has been pretty hawkish. I don't think we've seen Jay give us any dovish tidbits until today, in fact. And I think today he kind of did a little bit of a baby step talking about the cumulative impact of these rate hikes, which is going to be large. And I think he acknowledged that. But he still has the same message, which is that there's a lot of work to do. There's no quitting early. There's no premature celebrations that just because inflation expectations look well contained, that they're going to take solace from that. I think everything sounded like the Jay we've heard all year, but there was a kind of baby step move toward this idea that they're getting more toward the end game. And I think he's acknowledging that. And I think the market obviously wants more. The market's excited about when this is going to end, and they can kind of take their foot off the brake a little bit. But it is early. We all knew there was another rate hike to come in December and likely one in January, the sizing of which is really, I think, splitting hairs, 50, 75, 25. We just did 400 basis points in the last 8 months, and we're talking about, is it going to be 50 or 75? I mean, who really cares at the end of the day? I mean, you can make money off it, but from the impact on the economy, this is the fine-tuning part of the exercise. And I do think we have to look at least, to the idea that he's prepping us for, some sort of end game here as we go into Q1 of 2023.
So what's the move? The gut reaction here on all of that is get out of stocks. We're seeing every sector down.
I think the market came
now
in
utilities
really
are doing best. They're down 1%. No, go ahead.
Yeah, the market came in wanting a little bit more, thinking, there was some more pivoting, not a baby step, a bigger step. Jay may have been a little bit more aggressive just because the political rhetoric heated up. You have the Sherrod Brown letter. You have the letter from the other senators. Obviously, we saw him, in 2018 get very unhappy about political rhetoric and meddling in the Fed's moves. And actually, by the end of 18, he went a little overboard and had to reconfigure things in 2019. So we may be seeing that side of Jay a little bit, sort of drawing some lines in the sand with the politicians, which wouldn't surprise me. But again, I don't think the bigger message should be missed, which is that, this 400 basis points is a lot. They're acknowledging that it's a lot. There's some more to do. There's a ways to go. He didn't say a long way from neutral. He said a ways to go, which is similar, but a little less disconcerting than what he said in 2018. But nevertheless, I think, again, we're approaching this end bit, this fine-tuning bit, and the market's going to want more of it, and they're not going to get it as fast as they probably like.
So if that's where we are, David, when is the time to buy bonds? Because it's been sell them on higher rates, but it could shift to buy them on recession, right?
Yeah, and I think the other thing he did acknowledge is that the probability of a deeper recession is more severe because inflation isn't coming down that fast, which I think the market's not going to take a lot of solace in either. And he does seem to be comfortable making a mistake of over-tightening. Again, things that we wouldn't be surprised at hearing all year, but we're hoping to hear a little less of them. Well, the bond market didn't react very much today, Sarah. I think last I looked, 10-year notes had moved 3 or 4 basis points. On a Fed day, that's pretty small, especially with where implied volatility usually has it. So I don't think the rate market is that out of sync here. We're going up to, something in a yield curve across 4 to 4.5 to 4 now. We might have to go up toward pricing in 4.75 to 5 at the end. Again, we're fine-tuning this fixed income move. And really the question for the fixed income market is how long do we have to stay here? And I think Jay told you probably have to stay here a little longer. And so the fixed income bull story is just a little bit less exciting after this meeting.
So Karen Carneal-Tambor was on with us at Bridgewater. She said cash over bonds, cash over stocks. Still think the dollar has a fight left. Does that make sense to you? Cash over stocks and bonds?
I'm not that excited about that trade, although, you do get paid 4% and probably 4.5% on cash pretty soon, so it's going to look attractive. I think you're getting toward the point where you can play the ranges in the equity market a little bit more comfortably. Down 3,500 to 3,600, the lows that we hit in June and we just recently hit, I think are more buying targets, Sarah. And I think Jay's going to make it hard on the market to go up a lot. I think like he did at Jackson Hole at 4,200, 4,300, he's going to say, you know what, guys, if you really want to take it up there, I'm going to try to get inflation down faster because you're giving me that opportunity. So some opportunistic disinflation, if you will. So I think you've got ranges settling in here. And I would be more likely to want to play range trades, especially with high volatility like this, than I would be to just go park myself in cash and not partake in some of these moves. These moves could be quite big. We can bounce from the mid 3,000s to 4,000. That's a big move. So I want to be ready to pounce, really, because I think the downside story based on the earnings crash that people have been forecasting all year is really a poor story. And we've talked about that. We could talk about that another time. But I think there's some reason for a cushion on the downside. But I do think the upside has a lot of caps. So I'm really much more in this range bound, play the edges trade as we go into 2023.